Hi, I'm Sam Meredith, and today I'm joined by Rafael Gozlan, the Chief Economist with IBI Investment House, to discuss the economic situation in Israel. Firstly, it was announced recently by Prime Minister Benjamin Netanyahu that both corporate and value-added taxes will be cut to try and help boost economic growth. The amendment to these tax rates is likely to be in response to recent struggles in GDP growth. Though how do you expect these changes to impact Israel's economy?
The growth engine normally, the past used to be the export. It was an export-driven economy, but due to the sluggish global growth in the last year, actually the growth was consumer-driven. And in the second quarter of the year, the consumption growth was much more muted. Actually, it was really slow. So I think that's the case for acting to support to keep this engine alive, because as far as we see it, and especially given the recent developments in global markets, we shouldn't expect the export growth to be higher. So when you take into account also the fact that the monetary policy, actually we are in about the zero bound, the interest rate actually in Israel is 0.1%. So you should expect the fiscal policy to contribute to the growth, and that's what we see. So I don't expect it to do a lot, but I think it's the right approach to deal with the slower growth. And then I think it's we are going in the right direction. Probably it will elevate a bit the consumption in the coming year.
Okay, well, looking ahead to tomorrow, Israel's trade balance is scheduled to be released at 10 a.m. GMT, which is likely to have a significant impact. The trade deficit has been forecast by some to fall further still, but what will you be expecting from this data release?
The trade data, the monthly trade data is very volatile, but if you look at the trend is very clear. We see a slower growth, actually negative year-on-year numbers, and I expect it to continue also in July. We can read from the global export data, mostly EM countries, mostly East Asia. Countries like Korea, which are very correlated to the Israeli exports, and we saw quite bad numbers, bad prints over there in the last few days. So my guess is that we're going to continue to see a slower growth in Israel. You should bear in mind that Israeli exports are suffering at the moment from two factors. First of all is the sluggish global demand, and the other thing is, of course, is the strong shekel. We saw quite an appreciation of the trade-weighted shekel in the last year, and it's a trend of already like 2-3 years. And I think those two factors are going to impact and to continue to slow the export in the coming year.
Lastly, for today, which key indicators will you be looking out for in the short term that have the potential to significantly impact Israel?
Let's talk about, I think, two main factors. First of all is the behavior of the shekel. It's very it has much influence on the Bank of Israel. The second thing is the CPI, the inflation. It's going to be published next in the coming Sunday, and we expect a negative print in this August, which will be the first in a row, because if you take into account what we just talked about, the VAT cut, it's going to impact the October CPI, and we had electricity tariff reduction also in September. So lots of supply-driven factors are going to take the CPI to negative territory in the coming months. So I think we should look at these two numbers, because continuing pressure on the shekel and negative print in the CPI will have a major impact on the Bank of Israel. And if the global sentiment will stay negative, I believe they don't have much option but to cut more interest rate towards zero.
Thank you, Rafael. Be sure to check back with Dugoscopy for more updates throughout the week. Goodbye for now.